I worry that too many people are overall negative when there is opportunity here too. I mean, volatility breeds opportunity.
It absolutely does. And when we see the market go through these periods of volatility, it is an opportunity, particularly because you're not buying the market. You should be looking at individual opportunities that are now much less expensive than the overall market. That's exactly where the opportunity is in volatility. When we're buying something, we're looking 2, 3, 4, 5 years, and maybe even 10 years into the future. And particularly with what I'm going to be talking about in the webinar, we're looking into particular areas we know that are structurally growing into the future. So these are sectors and parts of the economy that are going to be growing. And when they come down the way they have, I mean, you look at the NASDAQ's down, 15, 16%.
Yeah.
A lot of these opportunities in nuclear, in battery power, robotics, in AI, and all of these areas have now come down into levels that are much more attractive than they were just in December or January.
Yes.
And that's where the opportunity is.
I'd love to claim some great timing here, but we booked Neil McIver some time ago. It's worked out perfectly for us when we see the action of the market. Neil is the CEO, the head of McIver Capital Management at CGI Wealth. Great to have you with us, Neil. Appreciate you taking the time.
My pleasure, Mike. Great to be with you this morning. And by the way, it's CG Wealth, just to make sure our
Yeah,
masters are
CG
happy
Wealth,
with that.
thank you.
Yes.
And I just want to say that where I saw this is that you've got a webinar coming up in midweek that's going to deal with a lot of this stuff absolutely free. And I'm going to put the stuff on our websites and our emails, etc. But it's great to take advantage of. But as we chatted with you, I wanted a chance just to get a touch on this because this is a difficult environment for people. But I worry that too many people are overall negative when there is opportunity here too. I mean, volatility breeds opportunity.
It absolutely does. And when we see the market go through these periods of volatility, it is an opportunity, particularly because you're not buying the market. You should be looking at individual opportunities that are now much less expensive than the overall market. That's exactly where the opportunity is in volatility. When we're buying something, we're looking 2, 3, 4, 5 years, and maybe even 10 years into the future. And particularly with what I'm going to be talking about in the webinar, we're looking into particular areas we know that are structurally growing into the future. So these are sectors and parts of the economy that are going to be growing. And when they come down the way they have, I mean, you look at the NASDAQ's down, 15, 16%.
Yeah.
A lot of these opportunities in nuclear, in battery power, robotics, in AI, and all of these areas have now come down into levels that are much more attractive than they were just in December or January.
Yes.
And that's where the opportunity is. Also, at risk of sounding, Pollyanna-ish, and I'm certainly not that. We're paid to be right as opposed to endlessly optimistic.
Yeah.
But there is a tremendous amount of opportunity, particularly in the U.S. market, over the next 6 months to 12 months as well too. So regardless of how you might feel today about the tariffs and about some of the uncertainty and the chaos that's been blown into this marketplace, there is opportunity on the midterm. Plus, we're going to be buying things that it's really not important what happens with the economy over the shorter midterm, because these are opportunities that are there and bare for us today to buy, and that's what we're going to be talking about at it.
Well, again, you're talking about buying specific investments. You're not buying the overall economy. And so within that you have opportunity. I guess, of course, that's what you're going to be talking about on the webinar on Wednesday. But
Yes.
yeah, I mean, I can see it, especially coming out of the States. We're still going to see an environment where we expect lower taxes and less costly regulation.
This is something, and it's an important point that I really want to make. And despite like all of the anxiety and the chaos of the tariffs have caused, and look, we can argue, and anybody can argue all day about the methods being used and how effective they're going to be. And there's certainly a lot of that. A lot of top economists are talking about whether or not it's going to be inflationary or not. But we have to keep in mind what the goal is of this U.S. administration. And the goal is not to slow down global trade and trigger inflation, which the media, I think, largely will have you believe. The goal is to negotiate the removal of trade barriers for the U.S. economy. So really the most dynamic economy in the world can sell its products again more easily to the global market. That's what the goal is. Also while onshoring as much U.S. manufacturing as possible. I think what you're going to be seeing over the next number of weeks and months is you're going to be seeing trade deals being signed with Japan, with South Korea, with all these different countries. That's all going to be good news. But take a look at the onshoring. I was just looking at these numbers this morning. Hyundai, $20 billion has been pledged in new manufacturing facilities. NVIDIA, $100 billion has been pledged.
Yes.
Taiwan Semiconductor manufacturing $100 billion in a new manufacturing plant, or two of them, I think. SoftBank, OpenAI, another $100 billion. Nippon Steel, $14 billion. Apple, half a trillion, $500 billion that they've pledged in new manufacturing into the U.S. economy. That's something like 2.5 trillion, and we're just months into this. So there's that opportunity. Plus, you've got moderating taxes and other intrinsic issues that are taking place in the U.S. economy that you're going to see in the second half of this year that are going to provide huge opportunities.
You're going to be talking about the Vancouver Growth Portfolio approach here. And I wanted you just, obviously I'm asking you to sum up years of work, but no, just give us a quick snapshot how you approach these things that way. Now I'm talking about individual investors using a portfolio approach.
Well, that's right. I mean, what we're famous for, certainly with your audience, is we run very sophisticated, risk-adverse primary models for our clients. Those are an all-your-money solution. They've got a tremendous 15-year audited track record and they've outperformed with a very low level of volatility. Now, the VGP, or the Vancouver Growth Portfolio, is quite a bit different. It's an all-growth hedge fund-like portfolio with a target net to client return of 10% annually. And it's achieved that. It's actually been around, even though we've just released it to the public and to your audience very recently. It's achieved a rate of return since day one, net to client, of 12.5% over 8 years. And it has just a very minimum investment of $250,000. And where that came from is we've got a very, very, very robust system of filters and processes to select individual stocks for our primary models. But we often find these great opportunities that are just simply too volatile for the primary models, where clients are asking us to manage all of their money. So we ended up putting these to the side and watching them, often lamenting the fact that we weren't able to purchase them in the first place. But what we eventually did, just for us here at McIver Capital Management, is we put them into a portfolio, began tracking and auditing the performance of that 8 years ago. That was just for us. We later expanded it to some friends and family, and just recently on your show a few months ago, we launched it to the public for the very first time. So it's all of those great ideas that we have that have too much volatility for the primary models. And then if we take a look at what's happening right now, we've got NASDAQ off fairly significantly. We've got the S&P off significantly as well too. Now is that opportunity. This is the volatility that we wish. So now's the time to be buying a portfolio like this and showing a little bit of initiative with these things. Mark Twain said, when everybody tells you that it's so bad, it's never going to get good again, take all your money out of the bank and put it in the market. And then conversely, when everybody says that it's so good, it's never going to be bad again, do the reverse. But I think it's the first one that he mentioned there. That's the opportunity right now. Is we want to take advantage of this volatility as we see.
And just quickly, you target things like AI, cybersecurity, nuclear power, digital innovation. I mean, all of that stuff, that we've seen growth, and expectations are for significant more growth going forward.
Absolutely. These are structurally growing parts. Is there going to be more nuclear power in the future or less? I think everybody intellectually knows this to be true. Is AI going to be used more or less in the future?
Yeah.
Are there going to be more or less cyber attacks in the future? So these are structurally growing parts of the economy that we specifically focus upon. But I want to make another point clear, because a lot of people might take that the wrong way. We'll still buy traditional oil and gas. We've got no ESG or DEI filters. We're here as 100% advocates for our clients' endless wealth. So if we see opportunities in oil and gas or any traditional part of the economy, absolutely we're going to take advantage of it. But right now, the structurally growing parts are the ones that we talked about. It's the battery technology, nuclear energy, robotics, digital economy, all of those things. Those are the parts that are going to be growing, and that's we want to use this opportunity for.
Well, it looks very, very interesting. And people, as I say, the webinar is Wednesday, 11 o'clock Pacific Daylight Time, Had to get that right, by the way, Pacific Daylight Time. But you can just go. We'll send you out the details. We'll do an email for it. We'll put it on our social media. That sounds fascinating. 11 o'clock Pacific Daylight Time on Wednesday. Neil, thanks for finding time. Busy time for you.
My pleasure, Mike. Thanks a lot.